Hello Accounting 1 students. This video is going to have to do with merchandising concerns. So up until now, we had been dealing with companies which are basically service companies. There was no product sold, it was a service. Now we're going to go to companies that actually have a product, something that they hopefully buy low and sell high. And there's a name for that. It's called inventory, yeah? That's the stuff that you have, which you are going to attempt to sell. It is a current asset. Why is it a current asset? Because a current asset is one that you expect to convert to cash within a year, which we certainly hope is the case with respect to our inventory. This could be the largest asset that a company has. In many cases it is by far the largest asset. And the management of this asset could determine how well a company is going to do in the long run. So let's see what the story is. Well, first of all, there are two accounting systems. There's the periodic accounting system and the perpetual accounting system. Periodic system is typically would be used by smaller companies. So there are literally probably hundreds of thousands of small companies that are going to be using this system. A more sophisticated system is the perpetual inventory system. So for starters, we'll use periodic, and then we'll come back to perpetual as we go forward. All right, so let's say we have a little flea market operation going here, and we are selling a product. And what is the product? We're selling sneakers. So let's say at the beginning of the year, January 1, we have in inventory, we have $10,000 worth of sneakers. That's what they cost, yeah? That's how much they cost us. Are we going to sell them for $10,000? No, we're going to sell them for more, yeah? Okay. During the year, do we have to replenish our inventory? You're thinking, of course we do. So during the year, we're going to have to purchase, and let's say we bought $80,000 worth of sneakers during the year. As the balances ran down in inventory, we bought new sneakers, and for the year, it's $80,000. So that brings us to a subtotal. Cost of goods available for sale. Okay? And remember, this is all cost, yeah? So, if we sold every single one of those sneakers, how much would we have left at the end of the year? We'd have nothing left. Is that going to happen? Of course it's not going to happen. So let's say at the end of the year, we take a physical inventory. All right, and what does that mean? Mean you're working out during the inventory? No, it means you're actually physically, you're counting everything. And let's say at the end of the year for our company, we have $15,000 worth of sneakers, all right, in the ending inventory. Counted. Now, is the counting of inventory, is that a big deal? In the real world, yes, that is a big deal. It is time consuming, it is disruptive, and it is generally really annoying to do. Okay, and it's not inexpensive. So, this is where we are. All right, we had $90,000 worth of sneakers that we could have sold, but we didn't. We didn't sell them all. We sold all but $15,000. If we do the math, our cost of goods sold, and that is a very widely used acronym, COGS, cost of goods sold, is $75,000. Mathematically derived from these numbers. And the only way you can get to that 75,000 is to figure out your ending inventory number. Actually count it up. All right, so where are we now? Here's our pricing strategy. Our pricing strategy is we are going to sell our sneakers for twice what they cost. Okay, now is that realistic in real life? Absolutely not. In fact, if you know of a product where we can double up on the cost, please let me know so we can start selling it. But anyway, this is all make-believe, right? Let's say at the end of the year, now what is this, sales? What is that? That's a revenue account, yeah? That's a revenue account. Let's say at the end of the year, we have recorded sales of $140,000. And you're thinking to yourself, wait a second. I thought you just said that we're going to sell the sneakers for double what they cost. If that was true, we should have had sales of what? $150,000. Or another way of looking at it would be is the cost of goods sold should have been $70,000. What apparently happened here is it should have been 70,000, yeah? What apparently happened here is $5,000 worth of our sneakers have apparently walked off, yeah? Disappeared, shoplifted, taken by employees, who knows what. We're out $5,000. When are we finding out about this? We're finding out about this at the end of the year, yeah? After we counted the inventory. So in terms of inventory control, periodic system is not strong at all. It is not, okay? It doesn't give you quick feedback on what's happening with your inventory. That's why larger companies are going to use a perpetual system. All right, so that's a big weakness. Now, where are we? Okay, let's look at some transactions. You know, the old debits and credits, yeah? So let's say on October 7th, we being ABC Company, we being the purchaser of merchandise, we purchased $10,000 worth of nickel-plated wing nuts. So for the cost of the merchandise, $10,000, it goes into an account called purchases. Now we're going to find this on an income statement, which we're going to look at in a little while. Okay. We're going to find that in the income statement. Now, was the merchandise shipped to us for free? Well, in many cases, it might be shipped to you for free, but let's say that in this case, there was $200 worth of freight charges. All right. Now, in the real world, you'd use an account called Freight In. The cost of having merchandise transported to your place of business. All right. So we get an invoice from the seller. Who's the seller? ABC is the buyer, XYZ is the seller. The total's what? $10,200. Let's say we're not paying right now. We're going to pay maybe 7 or 8 or 9 or 10 days later. Okay. So we're going to credit accounts payable. That would be a purchase on account, including freight, and the total is $10,200. That's where we are. Okay. What happens next? All right. An inspection of the what was supposed to be nickel-plated wing nuts, we find that 20% of the shipment was pink wing nuts. Did we order pink wing nuts? We did not. What are you going to do with the pink wing nut? Put it on a girl's bicycle? Maybe. What are we going to do? We're going to send it back. So we contact, in this case, XYZ, the seller, and we tell them there's a problem, and maybe we get what is known as a return authorization. But to make things simple, let's say that XYZ agrees to take back the pink wing nuts. $2,000 worth of pink wing nuts. So what we want to do is to debit accounts payable. What kind of an account is accounts payable? You know what it is. That's a liability, yeah? So debit the liability account, reducing the amount we owe by how much? By $2,000. And then we're going to credit. We could credit purchases, but we're not going to do that. We're going to credit an account called purchase returns and allowances. Why not just credit purchases? Isn't this like a reverse purchase? It is. What's the reason you set up a separate account, which was mentioned in the closing entry video? The reason is that you want to keep track of this. Are we happy that this happened? We're not happy, right? This could mean that the people in our purchasing department aren't doing their job properly, or it could be that your vendors are not reliable. Whatever it is, it's not a good thing. You want to keep track of it. Okay. What happens next? Well, what happens next is we're going to pay the balance owed. So here's our little make-believe invoice from XYZ. 1 million nickel-plated wing nuts. Freight was 200, yeah. And they're offering us 110 net 30 credit terms. So what does that mean in English? That means that we could take a 1% discount on the merchandise if you pay within 10 days. 10 days of what? Groundhog's Day? Your birthday? No. 10 days of the original purchase. So let's say that if we pay before the 17th, we can get the discount. All right. And we're also going to say that the freight, theoretically a pass-along cost, is not subject to the discount. All right. Now, we're going to get a discount on the goods that we returned? No, of course not. We're not going to get a discount on that. All right. So let's see how we're going to do here. Well, first of all, how much money do we owe at this point? We owe the difference between these two numbers. And after we write a check, how much are we going to owe? We're going to owe 0 after we write a check or otherwise pay for this. And it's going to be $8,200. Are we going to pay $8,200? No. We're paying on the 16th, so we're going to get a discount. We're going to get a discount on, for lack of a better term, it's probably not even in English, the unreturned merchandise only. Okay, so what's going to be my little calculation here of the discount? I'm going to take my 10,000 and I'm going to subtract out the 2,000 that I sent back, and I'm going to multiply times what? Times 1%, because that's the credit terms. And that's going to give us what? That's going to give us our discount. A discount of $80. $80. So we're going to pay $8,200? You say, no, we're not going to pay $8,200. We're going to pay $8,120. Yeah? So I'll credit our favorite account. And what's our favorite account? Always going to be our favorite account. I'm going to credit cash for 8120. Debits don't equal the credits. This is disturbing and potentially dangerous. Yeah? What are we going to do? We're going to credit an account called purchase discounts. For $80. And there you have it. You have a purchase on account, including freight, where there was a return, and we took the discount, and in this case, we assumed that only the merchandise was subject to the discount. Yeah? So we didn't get a discount on the freight. And you might be thinking, wait a second. I paid good money to have the 2,000 pink wing nuts, $2,000 worth of pink wing nuts sent. Well, the seller has agreed to send us some more nickel-plated wing nuts with no freight charge attached. So that's how we can play that one. All right, those are the books of the purchaser. What about the books of the seller? All right, books of the seller. Well, everywhere where we have accounts payable, on the books of the seller, we're going to have accounts receivable. Now, yeah? So we're billing out, what, 10,200? And we're going to credit sales. That's a revenue account, yeah? For 10,000. And then we got that freight, yeah? Now we could credit freight out, or even better would be an account called freight recovery. And what is this account? What's going to go in this account? What's going to go is the amount that you've billed your customers for shipping goods to them that you're adding to the invoice, yeah? Okay. Now let's think about this in real life, because in the textbook, in many of these textbooks, as a matter of fact, they have a transaction where you're paying Mr. UPS or Ms. UPS X amount of dollars. You, the seller, are paying them. So you credit cash, and according to these textbooks, you debit accounts receivable. That probably never happens. What really happens? Let's go over here. I think I got a truck over here. There's my truck. Holy Toledo, look at that. Do you believe this? Is this the most amazing thing you've ever seen in your life? I know, you don't have to say. Okay, so there's my truck, my UPS truck. Now what happens in our little make-believe company is that this truck, which is apparently driving around somewhere in Germany, it looks like, pulls up to our loading bays of our company. And in this truck, we put hundreds or maybe even thousands of orders, completed orders that we're shipping to our customers, yeah? And when we get billed by UPS, we're going to get billed for everything that we sent on this particular day, let's say October 7th. And probably, as I recall from my time as a controller of a manufacturing company, probably going to bill you on a weekly basis. So they're going to bill you for 7 days worth of shipments, which, just to pick a number, let's say that's 7,000 orders that you shipped. Now, what are you going to do? So you're going to debit this account, freight out. You're going to debit freight out for the charges that you got from UPS. You would debit freight out and you'd credit accounts payable or you'd credit cash, yeah? And then whatever you could bill to your customers, you could put over here. Now, this is one way of doing it. Some people probably wouldn't like that because you're netting out a cost. So you could put this in a separate account. You could put this in an account called, instead of freight out, freight recovery. We'll stick with freight out to keep it simple, okay? So, is it possible that you could bill your customers more than it cost you to ship? And the answer is, of course it's possible, yeah? So you could actually make money on the shipping component of this transaction. That's how it works in the real world. You're not going to make it. You're not going to make this transaction. That's not going to happen. That's the textbook deal, right? Added to accounts receivable. There's thousands of orders on these trucks, right? Are you going to do this 1,000 times? No. What are you going to do? Write out 1,000 checks? No. You're just going to add it to the invoice right here. And there you go. There's our sale, including freight charge. Okay. That's what they call FOB shipping, where the shipping cost is the responsibility of the buyer to pick up. But in the real world, the shipping cost is paid by the seller and then charged to the buyer. That's how it works. Okay, what happened next? The pink wing nuts, right? So we have to reduce our accounts receivable because we screwed up, right? We sent the wrong wing nuts. We could debit sales because it's like a reverse sale, but we're not going to do that. Why? Because we want to keep track of this. So we could use this account, sales, returns, and allowances, for the $2,000 worth of pink wing nuts. And why are we using this account? Why don't we just debit sales? we definitely want to keep track of this, right? If you're the seller of these goods and you have sales returns, are you happy? You're not happy at all because you screwed up an order, that's number one. And you might even lose the customer, who knows? All right, so you want to keep track of this, and of course, with that feedback, find the responsible parties, right? In the event that these things happen too frequently. All right, where are we now? It's the final receipt of the monies, yeah? And how much is going to be owed by the buyer after this transaction? 0. Okay, so if you look just the receivable part, it's pretty simple. That's what was billed. That's what we're reducing the original billing by. And so the last credit to accounts receivable is going to be $8,200. But we're not getting $8,200 because we are allowing the buyer a discount, yeah? We are getting $8,120, giving them a discount. That's costing us money to give a discount. In the real world, under the current economics circumstances, you would definitely take a 1% discount because the annualized rate is about 18%, which is gigantic, and you would take it every single time. You'd even take a 0.5% discount. Okay, where are we now? There's some transactions, right? Buyer, seller, okay? Are there more? Of course there's more. All right, so let's look at a couple of other scenarios. This will be a cash sale. So let's say we have a music store. Do they have music stores anymore? I don't know. All right. So we are selling, you can make it sneakers, right? We're selling sneakers that have a selling price of $100. And we sell them for cash. So we credit sales for $100, yeah? But since sneakers are taxable under the New York State sales tax rules, we're going to add to this, what is it, 8.625%. I'm going to round off to 863. So how much do we collect from the customer? 108.63, which includes the sales tax. Now, why are we creating sales tax payable? Because that's exactly what it is. We're going to have to pay this 863 to whom? To New York State. We're going to have to pay the sales tax to New York State. So all you're doing is collecting from New York State and eventually then remitting that amount, paying that amount to New York State. So here's my little sales tax payable account over here. And let's say we have a medium-sized, not very big kind of company, and they have less than $100,000 of taxable sales every month. So under those circumstances, they would be responsible for paying sales tax on a quarterly basis. Okay. So let's say in the month of September, and these are just summary numbers, okay. Let's say in the month of September, you had collected from customers $5,000 worth of sales tax, $4,200 worth of sales tax in October, and $8,100 worth of sales tax in November. So at the end of November, on November 30th, the balance in the account is $17,300. Now, the New York State sales tax does not work on a calendar basis. So they have different 3-month intervals. So September, October, November, that's a real 3-month interval. And you're responsible to pay this money by when? By December 20th, okay? You have to pay that money to New York State. So what happens in real life? You complete a sales tax return, which shows what? Shows all of your taxable sales and how you arrived at the $17,300. And you electronically, along with this return, you remit, you pay $17,300 to New York State to wipe out that balance. That's how it works. God forbid you don't make it on a timely basis, because the penalties are ridiculous. Okay, that's how it works. Sales tax, collect from customers, and then ultimately group together. Really, really big company, monthly they would pay in what? The sales tax. By the 20th of the next month, you'd have to pay in the sales tax. Medium-sized, smallish kind of companies, you're probably going to pay every 3 months with your sales tax return. Okay. Now, what else do we have? Trade discounts. What's this all about? Well, once upon a time, when I was a controller of a manufacturing company, we had excess space which was rented out to a store that handled marine supplies and so forth. Stuff for boats, okay? And some person that I knew wanted a big, as I recall, it was a Johnson engine. Now, what do I know about inboard engines that go on boats? Zero. I don't know anything about this. But I remember the price. It was $6,000. So I, as the controller, go into this company, which is, again, renting out a portion of the space that we had. And I tell them, oh, can you give me the trade discount on the engine? And of course, since I'm a representative of the landlord, they said, yeah, sure. And what was the discount? Well, the discount was $2,400. Trade discount, $2,400. So they sell it. They were going to sell this thing, and they did sell this thing to me for $3,600. It took 40% off of the list price. Now, see, how does this work? Let's say you get your car fixed, right? And if you go to a service station, and let's say you need a new alternator. Now, do I know what an alternator costs? No, I'm going to make up a number. Let's suppose if you go into one of the automotive supply stores, that you could buy an alternator, walk in off the street for $250. You could buy it for that. If on the other hand, and then you install it yourself. If on the other hand, you went to a station, service station, where they actually repair automobiles, and they go to fix your car, and they buy that same alternator, they're not paying the same price as you. You're paying the list price. They're paying what many refer to as the wholesale price, which is going to be a discounted amount. Now, this was this is a marine supply store. Were they still making money if they were selling this at 40% off? And the answer is yes, they were still making money. So give you an idea how much profit there would be in such an item. And that was a real story, and those are real numbers. So here's our transaction. We debit our favorite account, cash, assuming it was a cash sale, which it was. And we might put it into a separate revenue account. We could have sales wholesale and sales retail. Once upon a time, Professor Weinstein and I had an account, which was a very large automotive supply store. And they did what? They sold to people off the street at the list price, and then they sold to service stations at the wholesale price. So we had a separate account for sales wholesale and sales retail. And the sales wholesale had a much lower profit margin. Okay, so that's how it works with trade discounts. There is no account called trade discounts. Trade discounts are used to arrive at the ultimate selling price. And once you have that selling price, you might put it into a separate revenue account. Probably should do that if you ask me. But there's no trade discount account. That's how it works. So that's a pretty good smattering of purchase and sales transactions. All under what system? The periodic system. And the only way that you can get your cost of goods sold on the periodic system is what? Is to actually count up your inventory, if you want an accurate number anyway, count up your inventory and mathematically arrive at the cost of goods sold. That's how it works. That's how the smallish companies would do this, and literally hundreds of thousands of companies do it this way. Okay then, until next time, I'm going to look at a multi-step income statement. That'll be next.